forget how to do this. No. Okay, I have to do it after, I guess. So I'm going to mark this. Okay, so I just got a question about what website. We were talking like, do you use Bloomberg? Do you use CNBC? What do you use for headline news? And then someone says, what website to look for Fed interest rate forecasts? Okay, well, let's just do this. So we want Fed Watch. Oop. Here's me. Okay, Fed Watch tool. So let's take a look at this Fed Watch tool right here. Boom, 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 boom. Okay, this is, okay, this tool by the CME group looks at the contracts, essentially, signed between smart money investors. This is banks loaning other banks money so that they can meet their Fed requirements. Okay? This is Bank of America lending JP Morgan money for a day because balances increase and decrease all the time, 24 hours a day at a bank, right? But they're supposed to have a certain amount of money parked at the Fed. So every day at rollover or when they close their books, they calculate, we need to add some more money to the Fed. Or they say, we have too much money at the Fed. And then bank managers have to make decisions, okay? But very often what they need is just, let's pull back even further. Banks make money because you give them money. We call it a deposit. It's not a loan, okay? You deposit money at the bank and they're like, we're going to pay you 1%, let's say. Meanwhile, they lend the money to businesses or citizens that borrow the money in the form of a loan to pay for things like real estate. So asset-backed securities. Okay, right? A loan is a security backed up by the value of your house. So the loan on the books might be worth 75% of the value of your home. So if you default, they can sell your house for 25% cheaper than it should be, which means they can sell your house in a day, pay back the loan. Meanwhile, you're out on the streets again with bad credit. Okay, so that's how the whole thing works. You give them money, kind of like a loan, but not. You give them money in the form of a deposit. Now they have all this money. It's not likely you're going to show up and say, give me my retirement money back. Give me my savings account back. Okay? So anyways, so what they do is then they lend it in the form of a loan. Now that loan is locked in for 30 years. You could show up tomorrow and say, give me all my cash. I want to withdraw all my cash. I'm walking away. It could happen today, tomorrow. They just never know. But most likely you won't show up over the course of 10, 20, 30 years and say, give me all my cash. Okay? So they pay you a little bit on the front end and then they loan it out. So they're short cash, they're long loans. Okay? So every once in a while, you do show up and withdraw money, or a whole bunch of people show up and withdraw money, but all that money is locked into loans. So a bank could say, well, hey, I can go to another bank and borrow some money from them to make sure I'm all squared away with the Fed, because you have performing loans, you have cash flow coming in. You just need a little bit of help to cover your short-term liabilities because right now, you're short on deposits. Now, a bank will also have money invested in things like bonds. Not 100% of deposits are in loans. So they just need a day or two to sell off some bonds, get some cash, right? So they're picking up, they're paying you 1%. But they're picking up 3% in a corporate bond, or I don't even know, are they allowed to buy that? Anyways, they're paying you 1%. They're picking up 3% on a safe loan. They're picking up 5% on a mortgage. And that's how they manage the time-based liabilities, right? So a bank will say, well, I need a day or two to liquidate some of my bond holdings so I have enough cash to cover my liabilities. So I need to borrow for a day or two. And they go to another bank who just happens to have a surplus. And they don't want to lock it into a bond, and there's no one to really loan money to today for loans. They just have this excess capital, and they can pick up a quick buck. Bank of America lends it to JP Morgan. JP Morgan's not going to go bankrupt over the next 2 days, and then you'll get your money back plus a little something for your trouble. Easy peasy, right? Cool. Well, that contract is negotiated between bankers. Well, what if you thought tomorrow interest rates were going to go up? What kind of deal would you negotiate today? Based on today's interest rates or tomorrow's interest rates? Or a hybrid? Because you're like, well, I can loan you money today, but then you're locked in owing me money at the old rate, where if I just waited a day to loan it to you, you'd have to pay it at the higher rate. So I don't want to loan you money today. I'll loan you money tomorrow. And they're like, oh my God, I totally understand the situation you're in, but I need the money today. And they're like, well, okay, let's negotiate price here. And you come up with some hybrid plan. Now, in finance, it's just math. You can just calculate based on things like the time value of money, the value of a 1 day loan at today's rate, and then other, depending on how many days, what the value of the cash flow would be after the interest rate changed. And you just calculate the money and boom. And bankers are very like that. The only thing that changes is the discount rate and all that kind of stuff. Discount not meaning the Fed discount window, but your opportunity cost and such. But what I'm getting to is it's all mathematical. They're like, what's the time value of money today at this interest rate? What's the time value of money into the future at that other interest rate? Okay. And it's the change of interest rate that and how much time is involved comes up with an exact price. Bankers, real estate investors know this too. You look at a building and say, okay, what's the cash flows on this building? And then they go $3,658,322.72 is how much that's worth. Okay? Finance will tell you exactly the value of something if you understand the time value of money. Okay? And the change in interest rates, which would impact that over time. Great. So now we're looking at the interest rate and the time. Okay? So what if now a bank was borrowing money from another bank, not for overnight, but how about for a month? Or how about 3 months? How about 6 months? Okay? Typically in the course of a month, a couple of months, 3 months, 6 months, there would be a perceived change in interest rates. Okay? And maybe there's agreement and disagreement like in the future. Okay? Now, right now, the Fed is telling us exactly what to think, but things can change and people could have an opinion about that. And therefore, they would have a different opinion on what the Fed would do. When will the Fed raise interest rates? 2 years, 3 years, 4 years, 5 years. Most people would say within 5 years, the Fed would raise interest rates. What day? Which meeting? Ooh. Is it going to be 3 years from now? And then if it is 3 years from now, what meeting? What month will interest rates go up? Well, now you get to have a divergence in opinion, because at that point it's an opinion. Okay, is it 2024? Well, is it the January or the June meeting? Or is it the December meeting? Or a meeting in between? Okay? And what your opinion would change what you negotiate. So finance being the study of cash flow, okay, over time, because that's what flow means, cash over the period of time, and time impacts the value of money, right? And interest rates also dictate the cost of borrowing. you add all this up and having uncertainty on when these things will change, you can look at the price of the agreements between these smart money participants. Remember, this isn't dumb money. This isn't real retail traders. This isn't hedge funds. This is banker to banker. Okay? Cool. So now you can look at the price they negotiated in these agreements, okay, and figure out what their assumed interest rate will be. So if you go out all the way to September of 2021, some people, not many, some people think interest rates will be higher. And remember, it's not opinion. These are negotiated contracts worth billions and billions and billions of dollars. See, if you go to June, nobody in the United States thinks interest rates will be higher. If you go to April, nobody in the United States thinks they're not investing and negotiating deals with each other like interest rates are going up. Now you go all the way to September of next year, a small percentage of these deals, 3.1% versus 96.9%, a small number of the deals have been negotiated as if interest rates go up by a quarter point. Aha! With this information, you don't need to listen to the media or a talking head and say, hey, when do you think interest rates are going to go up? Who cares? I don't care what people think. These are negotiated multi-billion-dollar contracts. Contracts! Okay? Based on the time value of money calculating this price, 99.925. Well, to get to that number, okay, if you reverse engineer the math, it's saying some people think interest rates will start going up in September. Not many, but some. And if we can go out further, let's say if we could go out to September 2022 or September 2023, this number certainly would be higher. And we know what they're thinking based on how they're spending actual money. Do you understand? It's smart money, billion-dollar deals being negotiated all the way out to September. And from that, we know exactly what they've negotiated in their contract. The possibility of interest rates going up by a quarter point in September of next year. 100% factual financial mathematics can tell you that. Nice, right? Hey, can I get a high five for that? Now you know how to think like smart money. So I'm trying to answer the question, where do you go to read some sort of report about interest rates going up? You don't need that. You have those facts. You can speak factually about this information. Okay? And now you've become an expert because you can do the math. And now you can speak in front of your friends, your families, potential clients. You can go on TV and say, well, our analysis of the Fed funds futures market shows that interest rates are still not likely to go up in 2021, mostly because the Fed said they won't, but there's just the smallest inkling of people getting ready for that to happen. And by the way, I'm going to be heavily short the dollar when that happens. Oh my gosh! Oh my gosh, what? Interest rates going up and you're going to start shorting the dollar? Oh yeah, I'm going to start shorting the dollar way out in August. Front running this because once the media picks up the slight change in probability of interest rates going up, that's the beginning. And when that happens, in my opinion, and for many people that don't understand macroeconomics, they'll say that doesn't make sense. Interest rates in the United States going up means the dollar should weaken. No. I know that makes sense. I mean, I said that backwards. You think because interest rates are perceived as going up, the dollar should strengthen, right? Higher interest rates or perceived higher interest rates or perceived higher interest rates coming soon would increase the value of the dollar, and that's not right. It's not right. It sounds right. It's not right. It's easy to believe that, but it's not right. Now, if you're talking about Canada, sure, that would make sense. If you're talking about the Polish zloty, yeah, that would make sense. The reserve currency of the entire world, the currency of the largest economy in the world, one based on import and exports? No. What that means is the dollar will weaken. Isn't that nice? So let me book that so that we have it